Hello students, today we are going to discuss about the measures to correct excess demand. So in our previous video already we discussed about the excess demand. What is excess demand? It means when aggregate demand is more than aggregate supply, AD greater than AS. Now if there is excess demand, then we came to know that this is the inflationary gap. And how you can correct this situation. Suppose in our economy there is an excess demand, but how you can correct the situation to get the full employment level? Okay, so now you see there are two main policies to correct the excess demand. Number one is fiscal policy and number two is monetary policy. What is fiscal policy? Policy of central government. Monetary policy, policy of central bank. So first we will discuss about the fiscal policy. In fiscal policy there are two parts. One is the government expenditure and another one is the tax. Is it clear? In fiscal policy, one part is government expenditure, another part is the tax. If excess demand is there, then what fiscal policy will do? They will decrease the government expenditure. Why? So when government decreases this expenditure, then what will happen? Then government will demand less for the goods and the services. They will spend less for the development and it will reduce the demand and finally it can reach to the full employment. It means when there is the excess demand, it means more demand. It means more aggregate demand. So that's why government will decrease the government expenditure and it will decrease the demand and finally we can get the full employment level. Very simple. So government will decrease expenditure. Simple. Increase in taxes. If government impose more tax, then what will happen? Price of the product will increase. When more price, automatically demand will decrease. So we can correct this excess demand through the increase in taxes. Is it clear? So when government impose more tax, then price of the product increases, then people will buy less product because of increase in price. And it can correct this situation, excess demand. So under fiscal policy there are two parts. One is government expenditure and another one is the tax. When excess demand is there, then government will decrease the government expenditure and government and increase in taxes. It means when more tax, then more price, people will buy less and it can correct the excess demand. This is the fiscal policy. Then you come to the monetary policy, policy of central bank. There are two parts. One is the quantitative and another one is the qualitative. In control of money supply by the Reserve Bank or the central bank, we already discussed about the qualitative and quantitative. The same thing we are going to repeat here. But you have to remember, in case of excess demand, what bank is going to do? Not commercial bank, central bank. Now you see, excess demand means what? Aggregate demand is more than aggregate supply. In that case, increase in bank rate. So when bank rate increases, then cost of borrowing for the commercial bank increases. And that's why they will borrow less from the central bank and they will be not able to provide more loan to the public. It can reduce this excess demand. The same thing, increase in repo rate also. In that case, when when central bank increases repo rate, then again cost of borrowing for commercial bank increases. When cost of borrowing for commercial bank increases, then they will be not able to borrow more money from the central bank and they will be not able to give more loan to the public. So it will reduce this excess demand. Sale of securities. When there is excess demand, then central bank will sell their securities to the commercial bank. Commercial bank has to buy this security with the cash. So indirectly, central bank is going to withdraw the cash from the commercial bank, so that commercial bank is not able to give more loan to the public. Increase in LRR. So there are two parts already you know, SLR and CRR, same thing. So when central bank increases LRR, or you can say SLR or CRR, then definitely again commercial bank will have less money to provide as a loan. So it can also correct the excess demand situation. Is it clear? Quickly you see increase in bank rate. When bank rate increases, then cost of borrowing for commercial bank increases. So commercial bank will borrow less from the central bank, and they will be not able to provide more loan to the public. Same thing for increase in repo rate also. Sale of securities in year, central bank will sell securities to the commercial bank has to buy. It means indirectly central bank is going to withdraw cash from the and the liquid from the commercial bank, so that commercial bank will be not able to provide more loan to the public. Increase in LRR, same thing. So when central bank increases LRR or CRR or SLR, then commercial bank will have less amount for the loan and it can correct the excess demand. Then qualitative. Increase in margin requirements. So when there is a excess demand, then bank will increase the margin requirements. I think you know that margin requirements, the difference between the market value and the value of your property. Suppose you want to borrow money from the bank, and that's why you have to give some collateral like your property documents or other things. If bank says that 60% you will get as a loan, then why will you borrow? Why will you take 60%? 40% bank will take. Clear? So that's why increase in margin requirements. When excess demand is there, so bank will try to discourage you so that you will borrow less from the commercial bank, and that's why central bank will increase the margin requirements. Advice to discourage lending. Okay, it means like now excess demand is there, no need to provide more loan to the public for unnecessary things like this. Credit rationing means what? In case of excess demand, central bank can order to the commercial bank that don't give a loan to the public for not for any reason. See where actually they are going to invest. Don't provide directly loan to the public. First you see where they are going to invest. Otherwise you increase the rate of interest or you discourage. Clear? So this is the monetary policy. So again you see quickly how to correct excess demand. So excess demand means we know that AD greater than AS. There are two policies, fiscal policy and the monetary policy. Fiscal policy, policy of central bank. Monetary policy, central government. And the monetary policy, policy of central bank. So in fiscal policy there are two parts. One is government expenditure and another one is the tax. When excess demand is there, then decrease in government expenditure so that they can demand less. And in here increase in tax so that price increases and people will buy less. Simple. Quantitative, increase in bank rate so that cost of borrowing for commercial bank increases and it will help to reduce the loan or advancing loan. Same increase in repo rate also, sale of securities, increase in LRR or increase in SLR or increase in CRR. In qualitative instrument, increase in margin requirements, advice to discourage lending and credit rationing. So these are the things. But students, you remember If question asks measures to correct excess demand of fiscal policy, then no need to write the monetary policy. Be clear. So if you write the whole thing, then we will understand that you don't have the concept. That's why you have written everything. So read the question properly. What question is asking? If fiscal policy, write only these things. And if question is asking monetary policy, then you write these things. No need to write about the fiscal policy. Okay. So this is the measures to correct excess demand. It's very simple because these things already we discussed in our last chapter. Okay. So I hope you understood this lesson. But if you have any confusion, let me know in the comment.